2018 ended with a bit of a bang. A combination of trade worries, US political uncertainty, and concerns about growth caused risky assets to sell off and raise some important questions as we go into 2019. US monetary policy has been a real focus of attention over the past few months, and December was no exception. The Fed hiked by 25 basis points as expected, but the market's concerns are now increasingly focused around growth, and the question as to whether or not the Fed has already hiked too much, given signs that the US economy is beginning to slow a little bit. For 2019, the Fed expects to hike rates twice more. Market expectations, however, have shifted significantly. The market now implies no interest rate hikes in 2019. If we do see the Fed hike, it could be taken negatively by risky assets, because there might be concerns that the Fed is going to make a policy mistake, tightening monetary policy still further, even though you're beginning to see the economy slow down. Uncertainty in the US has managed to knock Brexit off the front pages for a couple of weeks, but it's still going to be a major event for the first quarter of this year. As we stand here today, the probability of Mrs. May getting her deal passed seems to have increased a little bit, but the range of outcomes is still very broad. If we do see the deal passed, we'd expect financial markets to take that quite positively, as it removes some of the uncertainty that we've had to live with over the past few months. There's a lot of uncertainty as we go into 2019, but the real focus for us should be around global growth. All of the issues that dominate the headlines, be it US government shutdown, trade, Brexit, all of these have implications for global growth. Now, when we think about the drivers over the past couple of years, it's really been the US and China, and both of those economies are showing signs of slowdown. So when we think about that, we need to consider the implications for corporate profitability and corporate earnings. And then we also need to consider the policy responses that you could see in the event that we do see these economies slow more than we might have expected. From a portfolio perspective, it's really about focusing on the long term and also managing the risk in these portfolios as new information and new data comes to light. And that's really where we'll be focusing our attention.